Hello and welcome to another video as part of the technical analysis series. This one is on market microstructure and it's a follow-up to the order flow video. Here's the outline for today's lecture. Lecture is a bit self-indulgent, but there we go. First of all, disclaimer, I know nothing, I am nobody, this is entertainment. Finance is bad and evil, just like capitalism, so don't do it. No general remarks, we'll get straight into it. Limit order versus market order, the two main order types, and most of the order types you see on whatever platform you trade are slight modifications or derivatives of these two orders. So let's get into it. The definition of a limit order, it's an instruction to buy or sell an instrument at a specific price or better. And the or better part means using a limit order guarantees that your fill price will not be worse than your limit price, but it can be better. So take a practical example, market A is trading at 10, that's its price, I set a limit order to buy at 8, and if market A begins to decline, my limit buy will only be filled at 8 or better, and the or better means less than 8, so 7.95, 7.9, whatever it may be. Now, I may get filled below 8 because it's better, and the reason for that is, as logic would suggest, if I'm happy buying 8, then the inference is that if I'm happy to buy below 8 as well because it's a cheaper price. Now you can set exceptions to that where if you want to buy only at 8 and not even below if it's a better price, like a post-only limit order, but in any case you will not be filled above 8 because it's a worse price. So you can kind of start to see that a limit order, the main benefit you're afforded is being able to tightly control the prices at which you are willing to trade and do business. And the drawback or the cost of that is that the limit orders do not guarantee execution. So for example, if price trades to 8.1 and reverses, whereas my limit buy was at 8, I'm not getting filled on that trade. In the same vein, if my limit buy is at 8 and price trades very little at 8 before reversing, I may get what's called a partial fill, which means only a fraction of my full buy order is filled on that move. Now, a market order, the definition is an instruction to buy or sell an instrument immediately at the best price currently available. Now, as we'll discuss, it's that best price currently available part that really varies and affects trade execution. However, a market order guarantees execution as to you get your position and the full size you want basically immediately, but it does not guarantee execution price because you get the best price that's currently available. And there are a lot of factors that affect that, as we will discuss. Now, a few distinctions between limit orders and market orders. You'll often hear limit orders referred to as, or people posting limit orders, but referred to as makers or maker orders, and that's because they are adding liquidity to the order book, and when market orders then come in, they trade against resting limit orders in the book, right? So limit orders add liquidity by allowing market orders to take that liquidity when they execute against them. And that's where the whole maker-taker type of things come from. Limit orders improve liquidity conditions and market orders reduce liquidity conditions by literally taking liquidity, right? And this is often reflected in different fee structures. You may get a rebate or typically a lower fee for a limit order or by being a maker, and you'll pay a higher fee by being a taker. And that's just to that displays the impact you're having on overall liquidity conditions. The basic trade-off between the orders themselves is, as we've discussed, the cost for being able to choose the price you trade, so that's with a limit order, you have tight control over the actual prices where you execute, is that execution itself is not guaranteed. So your limit order may go unfilled, you may get a partial fill, whatever it may be, right? And in the same vein, the cost for immediate execution when you're using a market order is that the execution price is not guaranteed. So if your market order is large or the market you're trading is less liquid, spreads are wider, market makers are quoting wide, whatever it may be, your fill price may be quite different from the price you see on the screen. So with that in mind, we can start to answer a rather fundamental question, which is why does price move? And the basic answer is that market orders move price. So as a reminder, market orders demand immediate execution and reduce liquidity in doing so. So in essence, when the number of market orders is greater than the number of limit orders at a level, market must move up or down to satisfy the liquidity demands of those market orders. Because again, they can't wait. They're happy to pay up. They're happy to get a worse price to guarantee that immediate execution. That's why they're using a market order. So take the practical example below. Market A is trading at 10. That's kind of its price. And there are $50,000 in limit orders at limit sell orders specifically at 10. And I want to buy $75,000 of market A urgently. Now, two things should kind of jump out. The first is the term urgently. You know I'll be using a market order. The second is that there is an imbalance between the amount that I want to buy, which is 75,000, and the amount of liquidity or limit sell orders available at that price for me to be matched with, right? So you can immediately see there's that imbalance created to the tune of $25,000, for example. So what would happen? I get filled for $50,000 at the price of 10, but $25,000 of my order remains unfilled because, again, I wanted 75,000. Now, the key point about a market order, it's an urgent demand for liquidity. Even if I get filled for 50,000 at 10, I can't just wait and sit around for the other 25,000. The market will look for the other 25,000 immediately, even if it's at a worse price, which in this case means a higher price. So price moves higher to fill the rest of my demands for liquidity, for example, $25,000 across 10.2 and 10.8, whatever it may be. So as per our definitions of a market order, my execution was guaranteed, but my fill price was not, as the market had to match or pair my liquidity demands urgently, and those orders were only available at a worse or a higher price. It's the basic premise that if I want to buy a lot at a given price, and there are fewer sellers than what I demand at that price, then I need to find more sellers. And where am I going to find more sellers? At a less attractive price for me and a more attractive price for them, which is higher. So I'm paying extra. I'm paying a premium to get that urgent liquidity, and that premium comes in the form of a worse price. And it's a higher price if you're trying to market buy, and it's a lower price if you're trying to market sell. Take another example. A guy at the bazaar is selling 5 bananas for 30 cents, another 5 bananas at 35 cents. Starving, I urgently need to buy 10 bananas. So I buy 5 at 30 cents, but again, my order is for 10 bananas. I can't just buy 5 and then I'm using a market order, it kind of just sits around and waits. I'm happy to pay a worse price to get that immediate execution. It's the whole point of a market order, right? So I still need 5 more bananas immediately, so I buy the other 5 at 35 cents, and the price of bananas increases as a result. So once again, it comes down to an imbalance between my urgent need for 10 bananas and the amount available at the starting price of 30 cents. So if I wanted to get the other 5, I had to pay up for them and settle for a worse price. So circling back to why price moves, it's when the urgent demands for liquidity cannot be fully met at a given price. Price must move higher or lower to meet those demands. Bid-ask spread. So the bid is the price at which a buyer is willing to buy, and the ask, or the offer it's sometimes called, is the price at which a seller is willing to sell. And the best bid is the highest bid at the market, which just means near current price and not just in the order book or anywhere in the book. And the best ask is the lowest asking price at the market, again, near current price, in terms of where market makers are quoting currently. So the bid-ask spread is the difference between the best bid and the best ask. So a narrow spread, you'll hear this term used. This is when the ask is close to the bid, and you have usually indicates a liquid market with some exceptions. And a wide spread is when the ask is distant from the bid, is a less liquid market. And you'll hear the term capturing the spread, usually in reference to dealers, market makers, liquidity providers, people posting limit orders, whatever it may be. And essentially the dealer will get filled at the bid and close that position at the offer, and that spread, that difference, is their profit on that trade, and we'll talk about that in detail in the liquidity and market making sections. Okay, so liquidity. It's often used as an umbrella term. I mean, just to first set the scene, if you will, there's a big difference between how liquidity and different types of liquidity is used in the literature, if you will, and how it's used on crypto Twitter. They're not completely different, but just to give you the canonical definitions first. And then we'll go into why we use it, how we use it in our niche internet circle. So liquidity is often used as an umbrella term to denote some version of, and again, it's like a mixture. It's not one of these things. It doesn't have to be all of these things, but it's the following. If I want to trade this thing with a bunch of size, how much price impact am I going to have? Or how much will it cost? Or how quickly can I do it? And I guess and or applies for all of those. So just to further define some terms, market impact, the average response of prices to trades. So if the average response of prices trades is large, say that's large market impact. If it's not, it's smaller. Liquidity, the specific sub-definition, is the size of the price response to a trade of a fixed size. And that kind of sets up this relationship as per the final bullet point, where if there's low market impact, you would say that's a liquid market. And if there's large market impact, you would generally say that's an illiquid or a less liquid market. So some definitions that also play into, conversations about liquidity. Spreads being the first one, as per the previous slides. Wide spreads generally suggest conditions of reduced liquidity, market makers quoting wider, and in those circumstances, by definition, crossing the spread or executing a market order becomes more expensive, right? You also hear the term depth used, which is the market's ability to absorb large market orders without a significant price impact. So you can see it's important to make the distinction between spreads and depth, because you can have a market where the spreads are tight, the best bid and the best offer are quite close to each other, but if those quotes are for relatively small sizes, you could say that the market is still less liquid because they would get crushed by a large market order, and that would have a large price impact. So just seeing how tight the spread is without looking at the size that's being quoted for that spread, it only gives you half the picture. Trading consideration is that liquidity in general is relative to an extent. So a trader with a 4 or 5 figure position size or portfolio will not face the same constraints as a trader with a much larger book or position size. So there's a case to be made for smaller traders to kind of dabble more with where they're on equal footing, which would be the lower and the mid caps. But in any case, the TLDR version is that liquidity is some combination of speed and immediacy. Right? How quickly can I get this order filled? The cost of trading, which plays into at least the kind of spreads that are being quoted, and also the market's ability to absorb large market orders, which is the depth of a specific instrument. Now, as per that sub point, in crypto Twitter parlance, liquidity also refers to resting orders above or below key swing points, like the whole SFP type of discussion, and we will talk about that, but just wanted to get the normal definition of liquidity out of the way first. Now, one crucial consideration, this sounds self-evident, but it can be confusing, is that liquidity conditions can and often do change, and there are tons of factors that can impact or influence liquidity conditions. Volatility, news events, session times, liquidation cascades, and all sorts of other things can change how liquid a market is at a given time. So it's important to have some understanding of those metrics we talked about, spreads, depth, etc., to know what type of market impact you may or may not have. So let's talk about order clustering and stop loss hunting and failed breakouts and breakdowns and essentially any version of the kind of reversal pattern you see. I'm not even going to show you charts because there are 10 zillion of them you've seen before on this channel, on the internet, whatever, but it's essentially this phenomenon where the market makes a high and then at some point trades through it before reversing and moving lower. Or in the same vein, if you're dealing with a level of support, you've got that as your bounce point. We can delineate the low, and then the market trades through it before reversing. So the question we're essentially answering is what happens kind of here, right? From a market microstructure perspective. Is it some bloke called the market maker who buys up a ton and then sells it down, or sells down a ton then buys it up, or is there something a bit more nuanced going on? My submission is obviously the second, right? So we're essentially answering what happens here, right? What happens here? Now, let's define some terms first and foremost. Order clustering is simply a large number of orders resting at the same price, and so there's a cluster, a collection of orders. Now, more specific order types, a stop market order is a market order that is executed only when price reaches whatever trigger price is set for it. And so if you think about the buy and sell side, a buy stop market order is a market order to buy when price reaches the trigger price. And a sell stop market order is a market order to sell when price reaches the trigger price. And typically these order types are used for stop losses and also by breakout traders. One final bit to remind yourself of is that longs closing must become orders to sell, right? So if you're +1 and you want to go to 0, you have to sell to get there. And then in the same vein, shorts closing become orders to buy. So if you're at -1, you need to buy to get to 0. Now, what's the market microstructure explanation of some of the stuff that goes on at these junctures that we've pointed out? A few things are happening. The first is that stop market orders cluster at a particular price. That's above a swing high, below a swing low, round numbers, all the stuff that would generally attract orders or used as a reference point by a large number of traders. So let's say this is some, round number swing high wick or breakout level that's important, and that's why orders may cluster above it, for example, right? Now, let's say price actually trades through that key point and it triggers a wave of market orders at once. And all those market orders, those market orders are primarily in the same direction. What we know from our market order section is that creates an immediate one-sided demand for liquidity. So let's take this kind of, I guess, bullish like breakout attempt example. If this is a key, level in the market and the market trades above it, we can then look back at our two groups. What kind of market orders are hitting as price trades through this high? Well, we know that a buy stop market is a market order to buy when price reaches the trigger price. And it's used for stop losses and by breakout traders. So as the market is doing this, existing short positions that sold at some point here, whose invalidation is predicated on this high being the high or remaining intact, as they sell their positions and get stopped out, those shorts closing become market orders to buy, right? That's group number one. And then you also have breakout traders for whom trading above this is going to be technically significant and they're expecting a move like that. Trading through this high becomes a market order to buy, trying to catch or force momentum. And those are our two groups as described here. So what happens? Price trades through the price, triggering a wave of market orders at once. We described the types of groups in this example participating, and that creates an immediate one-sided demand for liquidity. Now, as we know from our market orders section, price moves until the liquidity demands of those market orders are satisfied, and those market orders are being executed against limit orders. So what has taken place if you get that flood of market orders and then price starts to creep back down below the breakout point? Well, there are a few things going on. And this list isn't exhaustive by any means, but I think it's the most important stuff. The first in general is that liquidity conditions improve and return to normal given those demands have been met, right? So there's a bit of inbuilt or built-in reversion when that is the case. The second is that large limit orders have been filled. As we know, the only way those market orders stop impacting price is when they have been sufficiently paired with limit orders. And so when you get that type of slowdown, it's essentially those large market orders being soaked up and hitting a wall of passive buyers or passive sellers or just limit orders, right? Because as we know from our understanding of market orders, if there weren't the limit orders willing to soak up those market orders, it would just keep going until there have been sufficient limit orders to meet the liquidity demands of those market orders, right? So the fact that price essentially hits a wall or stops essentially means that that liquidity demand created by the flood of market orders has been met by limit orders. Now, the last two bits are very important, is that momentum chasers and breakout traders are offside and are forced to close. So in this example, let's say you bought this breakout and then price starts trading below the breakout point, right? You're very likely considering that you're wrong on the idea because it was supposed to look like this and it doesn't. As we know, longs closing create selling pressure, right? Longs close become orders to sell, and those orders to sell push price down a bit further, and then you have savvy traders who kind of waited to see the trap take place. They will also sell to exert further pressure on those trap traders and force them to close much more urgently. So in some effect, you have the opposite taking place, but in essence, it's a mixture of these conditions. I spoke to Adam from Trading RIOT. He believes that it's much more to do with momentum chasers versus traders being stopped out. I don't see why that wouldn't be the case, but in any case, it's still adheres to the basic principles of market microstructure that we talked about. You have one-sided demand for liquidity created by market orders hitting the market. Those have to be absorbed, otherwise price will keep traveling or moving until they are. If price stops, that means they've most likely hit a wall of sell orders, someone willing to soak up all those market orders from the other direction. And then as price moves down or moves, back below the breakout point or back above the breakdown point, these traders with market orders trying to force momentum and force a breakout, they realize they're wrong, they start puking, their pukes turn into orders to sell, and then the smart guys who are watching them puke will also sell to force them to close more urgently. That's really it. The TLDR version, I suppose, is market orders flood, limit orders soak, breakout traders close, smart traders step on their necks. That's really it. That's really it. Okay? Now, going back full circle to the crypto Twitter version, why do traders use the term liquidity when highlighting key swing points, round numbers, whatever it may be? Now, the answer is they're assuming that if the market trades through those prices or those key swing points, whatever it may be, a flood of market orders will be triggered, which creates a one-sided demand for liquidity. So as a result, it's kind of a bit of a misnomer, because as we know, as price trades through those key swing points, the flood of those market orders, creating a one-sided demand for liquidity, it actually reduces liquidity, because we know that market orders reduce liquidity. They're takers, right? They take liquidity. So if you have a ton of market orders flooding in at once, you'd actually expect, in the short term at least, liquidity conditions not to improve, but to deteriorate, which makes sense. So when it comes to traders using the term liquidity to denote those key swing points, the actual assumption at work is that there will be a larger limit order entity willing to absorb all of those market orders before leading to some sort of reversal. I just thought it's, might be helpful to go into the terminology or the history to some extent. So to generalize this activity, traders use the term buy stops or sell stops, or just stops in general to refer to this type of phenomenon. So for example, if we go through another bullish one where price is trading through a breakout point, and the claim will be that there are buy stops above X, so above that swing point, what does that actually mean? As we discussed, it comes from two groups. One is existing short positions closing. The second is breakout traders trying to buy, and both those groups want liquidity in the same area, and the market moves to find limit orders to satisfy those demands. Sometimes those demands will be satisfied quite close to the breakout point, so limit orders are willing to soak up that liquidity and drive price in the other direction, and then the momentum traders and the savvier traders kind of exacerbate the move. Other times you get a real breakout, as we'll discuss. So this is the important point, right? Not everything is a stop hunt or a trap, otherwise markets would never trend. A lot of these charts would look really rather absurd if you could always just kind of draw a wick and the market trades through it and then it goes down immediately and then trades through a low and goes up. You'd basically have these weird range-bound markets ad infinitum. That just doesn't make any sense. It's clear to us as observers that markets do trend. So how does that work? Well, the first thing to note is when it comes to choosing levels, to identify order clustering, the higher time frame, or in general more outstanding levels, they're the ones to go to. And the logic is rather basic, is that because they are big levels, they have more eyes on them, those eyes attract more orders, and more people are willing to use those levels as a reference point for their trades, and that leads to a larger order clustering effect, which would mean that once that type of pattern happens, you get a more significant break or reversal simply because there are more orders and or more participants trading it, right? So don't be that person on the 1 minute chart saying everything is an SFP, this is a stop hunt, market maker, took the stops, yada yada. It's probably not helpful and not accurate, right? And when it comes to breaks and reversals, now understanding what we know about order clustering and market orders and liquidity, it should be rather easy to articulate, which is the following. Are there sufficient limit orders near price to meet the immediate liquidity demands of all the market orders, right? So even if we take our simple diagram version of the following, this being the high, and then the market starts to trade through it, and as we know, a bunch of buy stops are being hit. Market orders to buy are hitting the market as price trades through this high, both shorts being stopped out and momentum traders trying to force the issue. Basic premise, are there sufficient limit orders near price to meet the immediate liquidity demands of all those market orders? So if these are all market orders to buy, the question is there a limit seller near the price willing to soak up all those urgent market orders? If the answer is yes, then you get what often is referred to a kind of stop hunt type of setup, and the market reverses for the reasons that we mentioned, right? The bigger limit sells have been filled, and the breakout traders need to close, and the smarter traders step on the breakout traders' necks and sell down, forcing their positions more underwater and for those longs to really be at pressure to close out, right? If the answer is no, that there aren't sufficient limit orders near price to meet the liquidity demands created by all the market buy orders in this case flooding in here, well then simply the market, as we know from our understanding, will continue to move higher until those liquidity demands are satisfied by limit sell orders, passive sellers, whatever you want to call them. So it all comes back to liquidity demands, right? That's really the first principle, which is ubiquitous throughout this market microstructure section. So it's like, what's the difference between, how do I know, or like, what's the difference between a stop hunt and a real breakout? Well, it's like, I mean, you could look at some stuff as we'll discuss, but essentially it comes down to, is someone willing to soak up all those market orders close to where they flood in? If the answer is yes, there is someone willing to soak, well, then you probably get some sort of reversal and the breakout traders eat shit. If the answer is no, no one's willing to soak, well, then the breakout traders make money. Final note, more of a kind of trading housekeeping thing, is no one has it out for you or your positions. It's very rare, unless you're some large percentage of the open interest in a specific contract and you're being clumsy with it. You know, there are edge cases, but honestly, for most listeners, if your stop placement is likely to be at a cluster of orders, it may be worth either reconsidering it or developing strategies based on those order clusters. This will really come from your trading journal and looking at what happens after I get stopped out, and is there a way I can either avoid that or actually create a setup from where I would ordinarily get stopped out. So that's some independent study impetus, if anything. Independent study impetus, nice. Okay. Liquidation cascades. We all love crypto futures and stuff, so liquidation cascades, bread and butter, right? The basic premise of liquidation cascades is that liquidations beget more liquidations. Now, what does the term liquidation actually mean? As per the risk management video, which you've hopefully watched, it's your position being forcibly closed by the exchange when you run out of maintenance margin, or collateral, essentially, required to maintain the position. Just like shorts closing become orders to buy and longs closing become orders to sell, long liquidations become urgent orders to sell, because those are longs closing, and short liquidations become urgent orders to buy, because those are shorts closing, right? So the very simple kind of loop that is created in a cascading liquidation environment is the following. Long position A is open, price moves down, and long position A reaches its liquidation price. As a result, long position A is forcibly closed, and that, as we know, longs closing means sell orders hitting the market. And sell orders hitting the market moves price down. As a result, long position B reaches liquidation price, and long position B is forcibly closed. That means more sell orders hitting the market, price moves down lower, and then long position C reaches liquidation price. Hopefully you see the pattern there, right? Now again, nothing too different in terms of market microstructure. It's still an imbalance created by the urgent demands for liquidity by those positions closing at market, and an insufficient number of limit orders willing to meet those demands at that price. So a lot of guys selling at once brings in more sellers in a loop when it comes to the liquidation cascade, and a lot of participants buying at once also brings in more buyers in a loop. So liquidation cascades are also exacerbated, so made greater or furthered by two things. The first is that group of savvy traders adding further pressure via market orders. Sometimes you can just smell a liquidation cascade. You know a large chunk of open interest is trapped. Maybe there's a technical setup to go with it, and you can basically exert pressure on those positions and hope to catch the market at a discount or at a higher or lower price, depending on which side is getting liquidated. And then also liquidity providers and market makers who are very cognizant of open interest and the proximity of the market to a cascading effect will also quote wider and provide less liquidity, because no one wants to get trapped, with a bunch of inventory in the middle of a liquidation cascade that's going to be hard to get rid of. And we will talk about what all of that means. But that's essentially liquidation cascades in a nutshell. It's the same thing, the pressure of a bunch of market orders flooding in at once, just on crack or on steroids. I don't know which one is more acceptable. This isn't monetized anyway. Okay, so market makers, a group, or an entity which we alluded to, a type of participant earlier. Obviously, it's the entity to which you attribute every bad trade or move that caught you offside. I mean, that's obviously a joke, but you'd be surprised how common this is, both on trading YouTube and crypto Twitter to some extent, where you see these big wicks or outlier moves, which are very easily explained with market microstructure basics, but the go-to understanding is that there's some bloke in Chicago at the CME just has this big red button on his keyboard saying run the stops, and then price wicks out, takes you out for your net worth of 0.004 BTC, and then price reverses, right? That's not really the case. So let's start from first principles. Market makers are liquidity providers, and that term should become familiar because we talked about how limit orders add liquidity to the order book, and they are makers and they improve liquidity conditions, whatever. So market makers performing essentially the same function. They provide liquidity by posting limit orders, which allow traders using market orders, or those who require immediacy, to take that liquidity. Now, the prices at which the market maker is willing to offer liquidity is essentially the bid-ask spread, the bid-ask spread, and that's their quote, right? That's their quote. You'll hear that, so you often hear like they're quoting wide, quoting narrow, whatever it may be, or asking a market maker for a quote when you want to trade a specific instrument. That's what that refers to. Now, as a quick reminder, I talked about that, limit orders add liquidity by allowing market orders which take liquidity to execute against them. So how do they make money? Well, essentially, market makers sell immediacy. Right? Traders fill market makers' bids when they sell using a market order, and they fill the market makers' asks when they buy using a market order. And so the market maker will typically make money by capturing the spread, i.e. buying at their bid and selling at their ask, and that spread is not just the bid-ask spread, but also the kind of profit on their trade. Now, a lot of the time, the realized spread, what they actually make from that transaction, is a bit less than the outright spread. It doesn't really matter all too much. And obviously, it's not as easy as it sounds, given, the frequency with which market makers have to price and reprice their quotes, especially to compete on larger exchanges and during volatility and a bunch of other factors. It's not super straightforward, and there's a reason all the high-frequency trading firms and quants have huge brains. So, going back to spreads in the context of market making, you'll hear the term narrow and wide spreads. As we defined, spread is the difference between the bid and the ask, the buy price and the sell price, also the bid offer, whatever you want to call it. So when you have a wide spread, you have a large difference between the bid and the ask, and a narrow spread, you have a small difference between the bid and the ask. And you can just kind of go and look at your favorite perp and kind of just study how prices are being quoted, what's top of the book, further away, and all of that type of stuff. Just paying attention to the tape can be very helpful in that regard. You can even go to a kind of aggregator of order books like Okotoki and kind of check out what they're doing. Again, not affiliated or anything like that, just some venues to observe the types of stuff we are talking about. Now, when it comes to market making, probably the most misunderstood thing, but also the most important thing, is inventory risk, right? So just to define some terms, inventory is the market maker's exposure to an asset. And in general, and there are crypto exceptions to this, which we'll talk about, in general, market makers prefer to be delta neutral as far as possible, and which essentially means if delta is directional exposure, simplest definition, having no or limited exposure to directional risk, because holding inventory typically means you're holding delta. So let's say I'm a market maker. I'm not. I'm too stupid, too bad at maths. So if my bid gets hit and I'm long 10 Bitcoin, so someone executed a market order, filled my bid, and I'm long 10 BTC, in the period that my ask isn't hit or my offer isn't hit, I'm holding 10 Bitcoins worth of directional exposure and all the associated financing costs with that position, whatever that may be. Then consider if the price of Bitcoin falls, I must quote lower asking prices to get rid of that inventory or to become delta neutral or go back to zero or offset that position, right? And that essentially turns into a form of buying high, selling low, or, whatever. With that in mind, we can then articulate what inventory risk actually is, which is holding exposure to an asset that you may not be able to get rid of in a timely manner as its value fluctuates, and usually in the form of moving against you, right? So that's why the ideal environment for market makers is a high volume, trendless, tight consolidation, which would mean there's lots of trading going on, so quotes being filled on both sides, and reduced inventory risk because the price of the underlying asset stays fixed. So you can see just from first principles, this flies to some extent in the idea that market makers love this like crazy whipsaw price action, up 10%, spikes the high, down 20%. That doesn't really stand up to scrutiny, although there are some exceptions which we'll discuss. Now, obviously, market makers have to mitigate their inventory risk, and there are a few ways of doing that. They can adjust their quotes. So if they have too much inventory, they can lower. They need to attract buyers to get rid of it, right? So they need to lower their asks to move them close to price, more likely to get hit. Lower their bids, make them less attractive, less likely to get hit. The opposite is true, of course, if they have too little inventory and they want more of it, they need to attract sellers. How do you do that? You raise your asking price to get it further away from the price, less likely to get hit, or you raise your bids to increase the likelihood that they get filled. There are other things they can do. You can change the sizes you're quoting depending on which side you want to get filled. You can actually become a taker if there's some urgency in evening out, and you can use other instruments, etc., etc. Not super relevant, but just to add some context. Now, toxic flow and dealing with informed traders is important. So as we've established, lots of inventory and big vol isn't typically desirable for market makers. And I will talk about some exceptions when it comes to the crypto caveats, but that's a very safe baseline assumption. So toxic flow is those two things essentially put together. We have informed traders, so smart money, with big size trading with large market orders into market makers. Because again, the smart money in that case, or the informed traders, will be taking with large size, and the market, reducing liquidity, and the market makers will be the one providing it. Now, what happens in that case is that market makers end up acquiring a bunch of inventory, which is the product of one-sided order flow. They're getting pounded with these large market orders, and it's all very one-sided. And that inventory becomes very hard to offset given the likely price impact of those large market orders. That's essentially the dynamic that exists with toxic flow. The mental calculation that's being made by the informed trader is that they're happy to trade into the market maker and suffer worse execution or wider quotes, whatever, because whatever information they have that they're trading on pays for the edge you would normally give to the market maker, right? Especially if it's a time-sensitive edge, be it speed or information or whatever it may be in that regard, you kind of have to use a market order because with every second of time that passes, presumably that edge deteriorates. So you're happy to pay for that urgency to take advantage of the edge. And that's kind of the first caveat. In principle, informed flow will still use market orders, especially when their edge is time sensitive. That's information, latency, and so on. In practice, what you'll see if you look at derivatives order flow, market orders and derivatives getting absorbed by a large passive buyer or seller is usually the catalyst for a reversal. That may seem somewhat contradictory, but it does make sense. Now, the final thing I'll note about market makers and being delta neutral, etc. Crypto is a bit of a weird one because a lot of crypto shops which do HFT work and have market making operations, they're not pure market making firms, right? They'll also take other trades and discretionary positions and put on deltas and so on. So, I listened to QCP Capital make some presentations, and I've talked to some other guys. If they think that the position they're being hit with is plus EV, or just like a good one in general as part of either another trading system, or just that someone's really urgently selling into them like near a bottom or buying from them near the top, they'll keep parts of that position on their book and not look to offset it immediately. So they'll take, basically the TLDR is they'll be happy to actually take on and keep inventory if they think it's at an advantageous price. So in this example, as I said, they'll often keep the delta if they think it's advantageous, or not rush to be delta neutral in all scenarios. But that's still, quite a far cry from some bloke sitting there saying, let's run the upside, let's run the downside, that type of stuff. Order flow, passive and active. So there are lots of tools that visualize order flow ideas. The most common forms are the following. You get some sort of order book analysis. We looked at Okotoki. You've got Trading Light, etc. You look at your heat maps and seeing where those passive orders are resting and how they're being moved. And then you've got tools displaying volume per price. And that's your Sierra chart, Exa charts, AGA, or any kind of CVD types of information. Those are showing that's active order flow. Now, what's the difference? So order book analysis and all of its derivatives is essentially passive order flow. That is to say, the main thing to focus on, it doesn't cost anything to show those big bids and offers, as those limit orders can be cancelled for free, right? And crucially, those bids and asks, especially larger orders away from the inside spread, they will shift as the market shifts, right? It's not a static thing. So sometimes you'll see people post up a picture of an order book and say, oh, well, there's only 50 BTC in asks until we go to X price. But if price were actually to start moving towards X price, the order book and the bids and offers being shown would also move as the price moves. That's what it's kind of stale order flow, if you will. It gives you a snapshot or preview of the market at a certain point, but you cannot expect that to remain the case as price actually moves. That's very important. On the topic of large bids and large offers, they're not automatically bullish or bearish. For example, they could be there in the large bids example to fill smaller orders, or to even push price into actually filling asks elsewhere or hidden orders elsewhere on another exchange. It's not always, thinking about it critically, it's not always economically efficient to advertise the full size you want to trade and the price you want to trade it and so on, because of the risk of front running, which is participants pushing price away from your limit orders and trading ahead, like trading your intention ahead of where you want to trade it. And also in crypto especially, it's fairly easy to mitigate that kind of parasitic trading. You can use hidden orders, there's OTC trades, block trades, and so on. So showing large orders can be as some sort of psyops, right? Other times it's actually very obvious what's going on, like there's just like a big limit chase going on, like we had in the 2020-2021 Coinbase US bidder. But my view is the following, right? In essence, given all the drawbacks and caveats that come with passive order flow. I think essentially order book alpha and strategies do exist, but they'll most likely come from specific idiosyncrasies or like a particular behavior in a given asset class or even a specific exchange. So in my view, you need to be really granular with what you're looking for, and not just saying, well, big bid equals bounce forever, big ask equals doom. It's usually not that simple and requires a bit more study, and it can be definitely used as like a confluence tool. Like even off the cuff, Bitfinex showing large bid walls at market inflection points tends to be a catalyst for, more often than not, is some sort of big catalyst for reversal. However, FTX doing the same thing, throwing up large buy walls, is, offers a much lower strike rate in that regard. So you'd think it's the same thing, price at a key inflection point, large bids come up, maybe, equals bullish. Well, it depends on which venue those bids are being shown, right? So you can see that it really comes down to the nuances, and I'm not comfortable making a video where I kind of extrapolate from first principles. Big bid wall equals buy because bullish, big sell wall equals sell because bearish. I mean, it makes for a shorter and easier video, but I just don't think it's true. Order flow, the active side is tools like Footprint displaying active order flow. So this is in contrast with passive order flow. This is buying and selling that has already taken place. It's not kind of resting orders or the intention trade or whatever. These are kind of economic transactions that have already taken place, and these different charts and tools in varying forms display the amount of volume traded at a given price level. Now, again, doing some sort of full order flow trading video strategy thing is beyond the scope of this video and probably beyond my ability. But in essence, using active order flow can be used to infer strength or weakness in a market by gauging the impact, or lack thereof, that market orders are having on price. So you can see it all comes back to market orders to a large extent. It's a very useful thing to look at, and the order and the impact they're having on a market. So most active order flow strategies, to some extent, are focused on patterns of absorption or lack thereof. So essentially, by absorption, I mean a large effort from market orders to move price with relatively little impact, which, as per our examples, would suggest that larger limit orders are being filled and are willing to soak up all that one-sided flow. I will say that, as a final note, lots of guru wizardry when it comes to, order flow in general, microstructure in general, but order flow, like active order flow specifically, there's a lot of like, just get by this DOM for 10 depth of market for 10,000, and you can see inside the candlesticks with this footprint and other kind of stuff. I had the privilege of speaking to Adam from Trading Riot on this topic, and that's a good blog. Go read it. It's got a great intro and advanced stuff and other materials on there. I wholeheartedly recommend it. But even he warned me when he was proofreading for me this order flow section that you'll probably get wrecked trying to day trade order flow anyway. It's not like, okay, I understand a microstructure because I watched a cred video. Now I can open up a footprint to see market buying and selling, and therefore I'm going to be this day trading genius. Very unlikely, but in any case, you can start to see how understanding market microstructure, specifically what market orders are and the type of impact they have, it kind of opens the doors towards a more general understanding of trading strategies and price action strategies, order flow strategies, whatever it may be, right? It's a good bedrock of knowledge to have. That's it, really. That's the conclusion, is that this topic is complicated, and I still feel like I've barely scratched the surface. I tried to almost avoid remaking this video because I knew how many topics I'd have to either skip completely or cover very briefly. Hopefully it's a decent kind of introductory base to encourage further learning, education, whatever. Per the second point, making directional bets is cool, but it doesn't hurt to know what you're trading, right? Be that the contract specifications or like how the market actually works, which is what we've tried to cover to some extent with microstructure. Final bits from me. I've got nothing to sell, right? I haven't got any paid whatever type of thing. That's how you'll know I'm wrecked. You can go back to this video if there's ever a crypto cred exclusive masterclass trading course, super secret, yada yada. Come back to this video and say, cred, you told me to come here and tell you you're broke now that you've got this thing going on. That will probably be the case. Yeah, so nothing to sell, just seeking dopamine. And if you'd like to do me a favor, given this is all free, like the video, that helps. Subscribe to the channel, because vanity metrics, and also leave a comment. Did you learn anything new? Do you disagree? Do you agree? I always read all the comments, and I'm grateful for your support and feedback over the years. Final point, follow me on Twitter as well, because why not? And that's all from me. In terms of stuff in the future, I think there are 2 more videos I want to make as part of the updated technical analysis series, and then we'll kind of see where we go from there. But that's all from me. Managed to keep this under an hour, which is shocking, but hope you have an awesome year, and yeah, I'd love to hear from you. Thanks for watching. Bye-bye.